my Windows needs an update. Okay, I'm just gonna get started then. So intangible assets. Intangible assets, what are intangible assets? Intangible assets are pretty much just assets with that, don't know how to spell that, without physical substance. Which means it's assets that we own that we can't physically touch. Something that does make us money, but is like, but doesn't have any physical substance, isn't a physical object. A couple of examples of or a list of intangible assets, the ones that you will be working with, are going to be patents, copyrights, franchises, and goodwill. So each of these has their own different meaning. Patents would be I think, check for a second. It was, yeah. So these patents have a 20-year life, and they're usually for a design. So patenting like a design for a specific type of coffee mug or a specific type of coffee maker, you can patent that design. So 20-year life for a design some sort. So that's kind of what patents are. Copyrights would be like using like songs, for example. You can copyright your song, which means people would have to pay you to use that song in things like films, video games, even just advertisements, all kinds of things. Copyrights, I believe they don't have a there, yeah. So a 70-year life, or as long as the person who holds the copyright lives, plus 70 years. So music is the best example. So music is the best example of a copyrighted asset because it's an asset that someone else owns, they came up with, but they have the right to use it as they want, and they can let other people use it as long as they pay them a certain amount. Now, franchises. These have let me see what their useful life is. So franchises are special in that they can have either a limited useful life or a finite useful life or a indefinite useful life. Which means that either they'll have a certain amount of time, kind of like how depreciation has an asset's useful life at 8 years. Patents can, or franchises can either have them at like 10 years or indefinitely, depending on terms of the contract with the person who's giving you the franchise, or the entity that's giving you the franchise. This would mostly be restaurants, stores. Think McDonald's, really. These are going to be the ones, or these are going to be the types of assets that will. It's pretty much one entity already has their own brand image. They have everything ready for you. Because McDonald's, they have their brand image already. They have their menus. They have their products, suppliers. They have everything ready and waiting. What they do when they franchise it is they basically sell it to another person. Let's say I buy a franchise of McDonald's. They give me the money, or they give me what I need, but I have to pay them. I think McDonald's charges. Last I heard, it was $1 million per franchise, but I'm not too sure because I heard that a while ago. So it could be wildly different now. But um, I would pay them a fee to get the franchise. They would set me up with supply with their suppliers. I'd get things that I'd need to run my own business in that way, and that's pretty much what a franchise is. You're getting a part. You're not really getting a part of it. You're getting something kind of pre-built, and you're just using that as a starting point. Now, goodwill is a special type of asset, intangible asset. It has an indefinite life, and only it only appears when we sell or when we buy an entire business. So what this is saying is we bought out a company. Let's say I'm McDonald. No, I already used McDonald's. Let's say I'm a lumber yard, and there's a business next to mine that I could see would be very useful for myself to own or to add on to my own property. So I talk to the owners of that business, I negotiate with them, and then I pay them out. Let's say their business is only worth $2 million, but I paid 2.5 million. That 0.5 million, or that $500,000 that was left over, that would go towards goodwill because it was appraised at 200 or 2 million, but we paid over that because we saw the value in having that property for ourselves. So we can't really say, and because we can't really say that, oh, we can't really put a price tag on how valuable that property could be to us since it's not an actual like determinable amount at the moment. You'd have to do the excess of the actual worth or actual value of that company and put it in towards goodwill. It'll show that we bought another company and we paid over what people say it's worth, but we think it's worth more because it'll give us some other kind of benefit that we can't really put into monetary terms at the moment. So I'll put it as difference between value of the company and what we paid for it. Now moving on to amortization. Amortization is uh, basically depreciation for intangibles. And for the most part, for intangibles that are depreciated, you would usually use the straight line method just because there's nothing you can really do for units of activity on intangibles since there aren't really any measurable units that you could use. And then there's the double declining. I guess you could use it, but even then, uh, straight line is much simpler. And since it is an asset with no actual physical substance, there's no physical deterioration. which means that there's no difference from year to year of what it's giving you, pretty much, unless you have something like brand image kind of messing around, but that's a different thing altogether. Uh, so amortization typically is going to be straight line for intangible assets, just because it's simpler and it's pretty much the easiest way for an intangible asset to be for amortization to be recorded for an intangible asset. Now, which intangible assets get amortized, um, and any intangible asset, with a definite useful life or with a finite life will be amortized. I think I also forgot to mention that I think patents can be renewed. I forget. Let me check really quick so I have my notes here. Um, oh, I almost forgot about those too. Another thing I forgot about was trademarks and trade names. Yeah. This would be things like the Nike logo, Coca-Cola logo, things that if they're internally developed, they would not have any. Oh yeah, I forgot. That's another thing I would want to talk about is the costs associated with them. So for the most part, any cost when you record, when recording tangible assets, recording intangible assets for when recording intangible assets, the cost is typically just the cost of fees to get either patents or copyrights. It's pretty much just whatever legal fees cost you, or whatever the cost of the legal fees were to get those patents, those trademarks, stuff like that. That's what the cost of that asset's going to be, even though like the Nike logo is worth way more now. If someone would want to try to buy it, they could reasonably charge a lot of money. But on Nike's books, since it was developed internally, all the only cost that it shows for it would be cost of legal fees to get it trademarked and stuff like that. And what would a journal entry, now back to this over here for amortization, what would a journal entry for amortization look like? It would pretty much look like any uh, journal for depreciation, or typically it would look like a journal for depreciation because you would have amortization and accumulated amortization. But I believe for this class, what they want is amortization expense and then just the intangible asset. And just the intangible asset title, not that one per se, but just the intangible asset that is being depreciated or amortized here. That way they get a direct write-off from it. So this would be, it's pretty much just amortization and what here would be a accumulated amortization if we did it like depreciation, but for this class we're just going to do it directly towards the asset itself. Okay, so now we're moving on to depreciation and disposal of plant assets. With time, I'm a little behind, but okay. So ArcLight Manufacturing recently purchased a $56,000 machine for its factory. The machine has an estimated salvage value of $3,600 and an 8-year useful life. ArcLight uses the straight line method for depreciation, given annual depreciation expense. what would the journal entry to record the disposal of the plant asset be if ArcLight sold the machine to another company for $19,350 after 6 years? What if ArcLight sold the machine for $15,225 instead? So one of the first things you want to do is highlight everything that's important in this question. So we're already given annual depreciation expense. So this first part over here where it's kind of giving us the inputs of depreciation, or the inputs to calculate depreciation, we're not going to have to worry about it right now just because we're already given that. We already know it's a straight line, so this is going to be depreciation expense for however long the asset's life is. So for this one, it'd be 8 years. But now we want to go to this bottom part here where we have what the questions actually want us to do. So given annual depreciation expense, what would the journal entry to record? So we want the journal entry to record the disposal of the plant asset if we sold it for either 19,000 after 6 years or 15,000 also after 6 years. So here we can see that one of the things that we're going to want to do is figure out how much that item has, or how much this asset has depreciated through those 6 years. And to get that, it's simply a matter of getting 6,550, the annual depreciation expense, and multiplying it by 6 years to see that we have $39,300 depreciated. Now we also want to know not only how much the asset's depreciated, but how much the asset has decreased in value because of depreciation. And that's also just a matter of doing $56,000, the original cost of the machine, minus the $39,300. And that'll give us $16,700. So now we know what our accumulated depreciation is. I'll put that in light blue. And what our remaining book value is. So now we're going to do the journal entry to record the sale at 19,000. So here we're going to have to do first cash, because that's what we're going to be getting. 19,350. Another account that we're going to want to get rid of is accumulated depreciation, because since we're getting rid of this piece of equipment, we're not going to need to record depreciation for it any longer, which means we have to get rid of that depreciation account. This is assuming, of course, that accumulated depreciation is only for one specific asset. There are some cases where, later on, as you advance with accounting, they'll have either pools of assets or similar assets that are all depreciated, and accumulated depreciation stays. It's only a portion of it that goes, depending on the asset. But for this class, it's accumulated depreciation for that one asset. Ooh, didn't mean to do that. So now that we have that, we can do 39,300. So now we have our accumulated depreciation. Next, we want to know. So next, we also want to get rid of the equipment that we have. So the equipment, even though we said that the book value is 16,000, the equipment is still technically recorded at the original cost. It's just depreciation is also added with it, and then during the actual balance sheet, you'll see it'll have the original cost, and then it'll have its depreciation, and it'll say less depreciation, and then it'll move it back to the side where it'll be added up in total for total assets. In this case, we're going to have get rid of equipment with original cost. So it'll be $56,000, but we also want to make sure that we get this part here. So we see that 56,000 and these numbers right here don't exactly add up. We'll see it's 19,000. Put it right here. See 19,350 plus 39,300. That'll give us 58,600, which is more than the equipment costs, or what the original cost of the equipment. So we do 56,000. So we get 58,650. And then we get $2,650 over the cost of the equipment. So to record that and make sure this balances out, we're going to do gain on disposal plant assets, and we will give it that same cost. We will give it 2,650, and that would be recording the sale of the disposal of a plant asset with depreciation, or with a gain. I don't know why I said with depreciation. So now for the other scenario, where we sell it for 15,000 instead of 19,000. So we're going to be doing cash again, because that's what we're getting out of this. And this time we're going to be doing 15,225. And remember, we also want to get rid of our accumulated depreciation. And that will also be the same, 39,300. Then we have our equipment. We also, didn't spell that right. That we also want to get rid of, which has a 56,000 costs. So now, once again, we see that it's not exactly matching up. So let's see, 15,225, add that to 39,300. That gives us 54,000. So now we see here that we actually have a loss, because we're going to have to do 56,000 minus 54,525. So in this case, the difference between the two is that this one is more than this. So in this case, the credit side, which is just getting rid of the equipment, is more than the debit side, which is recording the actual sale and removal of accumulated depreciation. So in addition to that, we're also, just to balance everything out, going to record the loss that we incurred. So we put loss of disposal of plant assets, and then we get the difference between the two, which is $1,475. And now both sides will match up. So notice that in this case here, any gains we had were credited as if they were revenue, you could say. You could think of it that way, if it helps you kind of remember where you put gains and where you put losses. But for any losses, we're going to be debiting it, just so we can balance these out. If you're ever unsure of where to put an account, think about not only what kind of account it is, like gain or losses. You can kind of think of them as similar to revenue, but not really. Well, similar in the sense that we're getting money, or in particular gains, we're getting money, and losses, well, you can just think of them as if they were revenue. So they usually depends. It depends really, but just think about where each account should go and how everything is balancing out, because that'll usually tell you a lot. If it turns out that the accounts aren't balancing, then there's something in the wrong place, and you'd have to see where each account, you'd have to reevaluate where accounts go. In this case, we have this side and this side matching up already, and this side and this side matching up already. So this one should be fine. Now moving on to the next one. So Lion Logistics recently purchased a new delivery truck at a cost of $45,000. So remember to go along as you go along to record important information, because for these I did not give what was it? For these I didn't give annual depreciation. I just made it so you can get the first 2 years of depreciation, and then you would get to the disposal of plant assets. So the truck costs $45,000. The estimated salvage value of the truck is $21,100. Line uses the units of activity method, so we're going to be dividing something eventually. And they estimate that the truck will drive 130,000 miles during its life. Given the table to the right, which is right here, giving us miles driven per year up to the 5th year, how would you record depreciation for the first 2 years? And how would you record Lion selling the truck to another company for $13,000? And how would you record Lion selling the truck for $92,000? Given after the 5 years, I'm assuming, I think. I forget what year I was. I think I forgot to put the year for this. Okay, well first we'll do this part here, and then we'll map out this and add on another row, another column to the right. And then we'll do depreciation expense on those. So first we want to do is get the depreciable cost per unit. So to do that, we're going to simply do 45,000, the first cost, the total cost of the asset, minus 2,100, which is the salvage value, and we get 42,900 as the depreciable cost. But now we want depreciable cost per unit, so we get $42,900 and divide that by $130,000. That gives us 33 cents per unit. Now to do that, all we want to do is have, let me move this over here so we can get a better look at it. So we want 26,500 times 0.33. And now we're going to just go through this and get our depreciation expense per each one by multiplying the miles driven in that year by the cost per unit, which is 33 cents. And that gives us depreciation expense for that year. So as we go down, we see 27,250 times 0.33. That gives us that year's depreciation. And this year also give us that year of depreciation, 0.33. And then this last year, 25,000 miles driven, 0.33. So now we have our total depreciation, or our depreciation expense for all of those years from year 1 to 5. So now to record the first 2 years of depreciation, we're going to do depreciation expense and accumulated depreciation. So now we have these. So now, for the first year, we simply look at the expense here. We see that it's $8,745. Same for this one here. 8,745. And now for this one, look at the next year, the second year, where 30,000 miles were driven. It's $9,900 for expense and also for depreciation, accumulated depreciation. So there, now we have the first 2 years of depreciation recorded. Now we can see about the disposal of the plant assets. So first things first, I'm assuming, since I forgot to write it down on this, that we're selling the asset after the 5 years. But to make sure, we can do the original cost of the asset, 45,000. And then we're going to subtract, or we're going to add up all the depreciation. So we're going to do 8,745 plus 9,900. Add that to 8,992.5 and add 7,986 and then 8,250. That gives us $43,000 in total. So I think I wanted to do this at the 4th year. Let me see. About okay, I think I wanted it at the 4th year because I remember I specifically made it a certain way. So $35,623.50. 5, and that'll give us, yeah, so it'll give us $9,376.50. Honestly, you can round up here and just make it just make it 1,377, just for the sake of it looking a little nicer. There are always going to be rounding errors in something like this, so just for this case here, just round up to the nearest whole number. So now we have that. So now we're going to record the sale, and this is at the 4th year. At the 4th year for that price. So to record sale is going to be cash, and then we're going to get, let's do this first one here at 13,000. It's going to be $13,000, and then accumulated depreciation at that point would be $35,623 and $624, or let's just keep it, just for the sake of everything matching the way it should. I think I'm going to go back and just leave it as 9,376.5, just so everything matches more exactly. But you can just round up if you'd like, but just for the sake of making sure I keep the numbers in line as I look at this, I'm just going to keep them all the same as they appear. So we have accumulated depreciation, we have cash. So now we get to see, is there a gain or a loss? So here we already kind of checked on that. We checked how much book value is left. So now we just compare it to what we're selling it for, and we see that there is going to be a gain since we're selling it for 13,000, but the actual book value of the piece of equipment is that right there, 9,376 and 50 cents. So that means we had a gain disposal net assets. It will be the difference between that and the equipment. The equipment's cost is going to be 45,000. So now to get this part here, what we're going to do is add up $13,000 and then add $35,623.50 and then subtract that by the $45,000. $48,623.5 minus 45,000. That gives us $3,623.50 as our gain. Now for when we record a loss, what we're going to do is have it be cash as well, also accumulated depreciation. We're also going to get rid of equipment, but we also have to see, are we going to have a gain or a loss? So 92,000, and we see that it is less than what the book value is by a little bit, but it is still less, so we still have to record it at a loss. So we're gonna have loss on disposal plan assets. So cash is gonna be 9,200. Accumulated depreciation is gonna be the same as the other ones. 35,623.5. And then equipment or loss is going to be the difference between the 45,000 minus it's going to be 45,000 minus the 35,623.5, also minus the 9,200. That gives us the difference and lets us do 175 or $76.50. That means that we can even it out with equipment, which is also going to remain the same, 45,000. That's how you record disposal plan assets on there. Okay. So now the next problem, and probably the last problem we're going to get to work on, I only have 6 minutes left, so we're probably not going to get to this last problem, which is going to be the same thing as pretty much all of these here, except just using a different method for calculating depreciation. So as long as you're comfortable with most of the methods for calculating depreciation, you should be fine, simply because disposal of plant assets, even depreciation itself, The journal entries are the same, it's just the calculation that's a little different. And honestly, some of the more difficult ones are going to be uh, just the units of activity or even the double declining method. The double declining method, I'll go over this one a little bit first just because we're running out of time, and this one's a little more difficult than the unit or the straight line method, even if this one has a fully depreciated asset in its problem. Uh, as long as you remember that up to that point, how much has the item depreciated, you'll be able to figure out book value at that point, at the point of sale, and then record gain or losses accordingly. But for this one, I'll just get the depreciation expense for the first 2 years on this one. So here we have $74,000 for a sawmill for Fairfield lumber, expected to have a 10-year useful life. Remember to always, whenever you have a problem like this, always try to pick out the pieces of information that you actually need. Estimated salvage value of 3,700. Fairfield uses double declining method. So since they use the double declining method, you don't need to worry about the salvage value. Double declining never worries about salvage value. So I'll do the first year. Or first, let's try to get the double declining rate. To do that, we get 1 or 100% and divide that by its useful life, which is 10 in this case. We have a 0.1. And since it's double declining, we multiply that by 2, and we get our double declining rate of 0.2. This is a straight line rate here. 0.1 is straight line rate in light blue, and 0.2 is the double declining rate in dark blue, or in yellow. So that's one we're going to be using. So for the first year, we're going to do is get the original cost of $74,000, multiply that by 0.2. That'll give us $14,800 for the first year of depreciation, and we record it accordingly. And now we also want to find out how much is left in the for book value, because we're going to use that number for the next year to calculate depreciation. So we do 14,000 or 7,400 minus 14,800, get book value of 59,200. So for year 2, it's going to be 59,200 multiplied by 0.2 gives us 11,840. 59,200 minus 11,840 gives us the remaining book value for that year after that depreciation. So that gives us the first 2 years of depreciation. And in order to get to the 6th year, as this next part of the question asks, you would have to just keep doing this same process, repeating it until the 6th year. Okay, my count a little messed up. Honestly, for something like this, if you know how to use Excel, there's ways you can do it where you can automate it. All you'd have to do is write up maybe the first line, and then all you have to do is drag and drop, and it'll give you like a depreciation schedule. It'll tell you, oh, this is year 1. This is going to be the depreciation for that one. Excel would be really useful for this, but since you are not allowed to use Excel for exams and stuff, I wouldn't get too reliant on it, but it is a good tool to have just because it does some of the more tedious tasks for you, like finding out the entire depreciation schedule for this. So that is pretty much all I have time for today. I do recommend that if you haven't been to any of my sessions before, that you come to my sessions. I have sessions on Mondays at 3 p.m. and Wednesdays at 5 p.m. And then I have these Friday sessions on a bi-weekly basis. So this week there's this session. Next week there won't be a session on Friday, but the week after that there will be a session on Friday, also at 12 p.m. this time. Uh, Other than that, there's also sessions hosted by Navcron, who has them on Tuesday and Tuesday and Thursday. Tuesdays at 3 around 3 p.m. and then Thursdays at 12:15 p.m. So if you can't make it to mine, I encourage you to make it to go to her sessions as well. She has some pretty material to cover, and she has a she definitely has a good understanding of these concepts as well. So she could definitely help you out if I'm not able to. Also, um, yeah, that's pretty much it. Have a good day.